What if I told you that the real war fought during World War I wasn't just in the trenches, but in bank vaults? What if the tipping point of the war came not from bullets, but from bonds and ledgers? What if today's global financial order and the inequalities we rage against were shaped by secret deals made under the cover of global conflict? You know, the battles, the blood, the generals. But few know the hidden financial war behind the world's greatest cataclysm. This is the story of how debt, inflation, and shadow banking determined the rise and fall of empires in 1914 to 1919. By the end, you'll see how the same patterns are still playing out, and maybe who's paying the price today. To understand the hidden financial war, we need to start with the global financial system before 1914, a fragile architecture built on gold, trust, and credit. In the early 20th century, 59 nations were on the gold standard. Their currencies were backed by gold reserves. Central banks and private banks formed a delicate web that connected the world's economies. In normal times, this system worked. But when an entire continent went to war, the pressure would prove fatal. In July 1914, as tensions rose, markets panicked. A diplomatic crisis turned into a financial crisis. Within weeks, stock markets crashed, bank runs erupted, credit froze, and some 50 countries saw panic withdrawals. The foundations of global finance began to crumble. Even before the first bullet was fired, the world's monetary system was already collapsing. This is where our story begins, a war not only of armies, but of liquidity, debt, and collapse. We'll follow it in 5 phases. The origins, how pre-war finance made the conflict possible. The rise, how empires scrambled to fund mass mobilization. The breaking point, how inflation, debt bubbles, and politics strained the system. The fallout, how the financial world was remade. And the failed fixes, the patchwork solutions that set up the next global crisis. Then, we'll draw the parallels to today and reveal the repeating patterns you were never taught. In the years before 1914, Europe was not only a powder keg of alliances, but a battlefield of money. Industrialization, colonial empires, and global trade all depended on credit and capital. London was the banker of the world. Paris and Berlin financed infrastructure and colonies. Private banks and state treasuries were deeply intertwined. But behind this apparent prosperity, nations were drowning in deficits. Many had weak tax systems, and the rigid gold standard meant that in times of stress, money could not expand fast enough. When Austria-Hungary confronted Serbia, the first domino fell. Alliances triggered. Confidence vanished. The great financial crisis of 1914 erupted. Credit froze. Banks failed. People lined up to withdraw their savings. Gold vanished from circulation. The age of stable money was ending. Governments would now be forced to rewrite the rules of finance to survive. Once war began, the challenge was clear. How do you pay for a total war? Millions of men, endless munitions, global logistics, all demanded money on a scale the world had never seen. Taxation couldn't keep up. In Britain, only about a quarter of war spending came from taxes. Germany, Austria-Hungary, and others relied almost entirely on borrowing. Debt would become their weapon and their curse. Nations issued war loans and bonds to rally the public. In Germany, patriotic war bonds flooded the market. In Britain, vast sums were raised from institutions and wealthy investors. And in America, when it joined in 1917, the Treasury launched the Liberty Bond Drives, an unprecedented propaganda campaign to turn citizens into lenders. Posters urged by bonds beat the Hun. Schools, churches, and factories organized rallies. Celebrities and war heroes sold bonds in the streets. It worked. More than a third of American adults bought Liberty bonds. The U.S. raised over $22 billion, more than any campaign in its history. But this patriotism had a price. People were lending money at low interest, while inflation quietly eroded the value of what they'd be repaid. The government was borrowing not just from citizens, but from the future. At the heart of this financial transformation were the central banks. Under the gold standard, their role had been limited. Now, they became engines of credit creation. In the United States, the Federal Reserve, just 1 year old, was suddenly responsible for financing a world war. It acted as the Treasury's arm, suppressing interest rates, buying bonds, and providing easy loans to banks. Independence vanished overnight. In Europe, the story was the same. Central banks printed money, extended credit, and quietly inflated away the real cost of war. The gold standard was effectively dead, even if no one dared say it aloud. The age of fiat power had begun. At first, the system held. Borrowing financed armies. Inflation was tolerated. But by 1916, the cracks widened. Prices surged. Civilians felt the strain of rationing and shortages. By the war's end, most major powers were drowning in debt. Britain's national debt ballooned from £600 million before the war to over £7 billion by 1919, more than a tenfold increase. Germany faced a financial collapse. To pay its soldiers and suppliers, Berlin printed marks in ever larger quantities. Each new issue devalued the currency further. By 1918, paper money had replaced gold completely. The seeds of Weimar hyperinflation were already sown. When the guns finally fell silent, the financial chaos didn't. The war's debts had to be repaid, somehow. The victors demanded reparations from the defeated. Germany, already bankrupt, was ordered to pay colossal sums it could never afford. The Allies, in turn, owed billions to the United States. The web of debt entangled the entire world. Then came a shocking blow. In 1918, the Russian Revolution erupted, and the new Bolshevik government refused to honor the Tsar's foreign debts. Investors from Paris to London were wiped out overnight. Trust in sovereign debt shattered. If a great power could simply walk away from its obligations, what was any bond worth? This cascade of defaults and broken promises sent shockwaves through global markets. Many nations teetered on the edge of bankruptcy. The war had been won, but the financial peace was failing. There was another, quieter battle underway, one of class and wealth. During the war, financial elites had bought bonds and earned interest. After the war, inflation reduced the real value of those holdings for small investors, but major institutions often found ways to profit. Working families faced higher prices, new taxes, and stagnant wages. The same pattern would echo a century later. Crises that transfer wealth upward while ordinary people pay the hidden cost. In the United States, counties that had heavily purchased Liberty bonds actually saw their local banks weaker a decade later. Patriotism had turned into long-term financial strain. After 1918, nations tried to rebuild order. They aimed to return to the old gold standard, hoping stability could be restored. But the world had changed too much. Britain restored its currency at pre-war parity, an overvalued rate that strangled exports and triggered deflation. Germany, crushed by reparations and internal chaos, spiraled into hyperinflation by 1923. Millions lost their savings as prices multiplied hourly. In desperation, governments turned to short-term fixes, new central bank policies, international loans, and temporary stabilization plans. None could erase the fundamental imbalance. Too much debt, too little trust. The system staggered forward into the 1920s, but the unresolved pressures exploded again in 1929. The Great Depression was, in many ways, the final chapter of the First World War's hidden financial war. So what patterns emerge from this century-old story? Why does it matter today? Because the methods invented then, deficit financing, patriotic bond campaigns, monetary manipulation, still define our world. Every major crisis since has repeated the same logic. Borrow first, stabilize later. Let inflation or future generations absorb the cost. During the Vietnam War, U.S. debt soared. In the 2008 financial crisis, the pattern returned. Massive borrowing to prevent collapse. During the COVID-19 pandemic, governments once again issued record debt, expanding central bank balance sheets, just as they had during the Great War. The tools may have changed: digital currency instead of gold, central bank swaps instead of war loans. But the essence is the same. Governments facing existential crises reach for the same weapon: debt. War and debt share a dangerous chemistry. Each feeds the other. War demands debt. Debt justifies war-level spending. Both transfer power from citizens to institutions. And both leave behind inflation, inequality, and distrust. Sovereign defaults in modern times, from Argentina to Greece, follow the same tragic script written in 1914. A government borrows too much, confidence collapses, and the burden falls on ordinary people. The concentration of wealth among financial elites is another echo. During World War I, the banking class gained influence as states became dependent on them. Today, major financial institutions wield similar leverage over public policy. History, it seems, didn't end. It was refinanced. By 2025, many advanced economies have debt-to-GDP ratios over 100%. Inflation has surged, eroding savings. And central banks, once again, stand caught between their duty to stability and their role as enablers of government borrowing. The ghosts of 1914 linger in every bond auction, every budget deficit, every quiet meeting between finance ministers and bankers. The same hidden war continues, less visible, but no less real. So what can we learn? 3 lessons stand out. First, debt is a hidden weapon. Wars, crises, and grand projects are rarely paid by taxes. They're financed by promises. Those promises shape the future long after the crisis ends. Second, financial systems can break before armies do. When credit collapses or inflation spins out of control, nations crumble from within. Power isn't just about who has more guns, but who controls the flow of capital. Third, history sets precedents that never really die. The propaganda of war bonds, the subordination of central banks, the quiet enrichment of elites. These patterns reappear in every new crisis. Understanding them isn't just academic, it's survival. And here's the warning. If we keep treating debt and credit as neutral tools, we'll never see who wields them. Every war, every boom, every bailout hides a financial story, a struggle over who controls the money and who pays for the consequences. So ask yourself, are we entering another